Hello, everybody. This is John Blank, Zacks Chief Equity Strategist and Economist. Today is Monday, March the 11th, 2024. What I'm going to do is part of a series of talks we're going through, which is our top picks in sectors for 2024. This one will be about our, quote, retail and wholesale sector. Now, in this sector, there's going to be just two big groups, food groups and non-food groups. And retail and wholesale, in some respects, will be retail like shops, physical shops, or big box stores from chain restaurants, things like that. And wholesale will be, in many ways, the internet, direct to consumer from a warehouse. So we got three parts, like we do in all of these pieces. Top picks for the retail and wholesale sector, just by the sheer scale of the market capitalizations. Who has the big footprints? Who are the big stocks? This is always where we'll start with these types of analyses. Then we'll go into the next one, by the number of analysts covering the stock. What is Wall Street really putting the time in? Where are they paying analysts to cover stocks for people who buy stocks? Very important to match up market capitalization with the number of analysts, making sure that we see this, and largely these will be the same stocks. Part three is the largest 1 month percentage change in current fiscal year earnings estimates. This is core to the Zacks Rank, and it will pick up an entirely different set of companies, growthy companies, companies that are newer and smaller. So this will be, again, we've seen the strategy before. We'll play it out once more for you. So here we go. First off, these are my views and not necessarily the views of Zacks. I'll let you read through this later at your leisure. All right, our top picks in the whole retail wholesale space with market capitalization being our first part. Here's all the companies that we're going to look at. Now, these are 7 to 8 stocks in these spaces. So over here, you've got, your Walmart, your McDonald's, Starbucks, CVS, Compass Group, which is a group in the UK that is a food service company, Kroger, Yum, and of course, Amazon, Home Depot, Costco, Baba, Pinduoduo, and China, and Lowe's. Down here, you've got the number of analysts coming stocks. So, for example, here we have Chipotle Mexican Grill, but it is actually the most covered stock of the big ones. And you'll see why. I mean, it's a growth company. Surprisingly, Darden and Domino's, again, more growthy names that people are interested in. Down here, Wayfair, the least of these covered stocks because of some of the problems it has. And I also want to point out here, non-food is always lower and smaller than food. So food is bigger in both the number of covering analysts and in the sheer market caps. Fascinating. So the only stock that's in all three categories of large cap, large coverage, and growing estimates is, of course, the mega cap Amazon. Keep that in mind. We're finding out just why Amazon is such an attractive stock, because it's been hit by all three levers here. Now we're going to get into some names here that are growthy names. You can see here, Farmer Brothers Coffee, Kappa Group. They're a Mediterranean restaurant group based in Washington. Shake Shack, of course, the company that's kind of important in New York and then spreading out. Potbelly. Carol's Restaurants. This is going to be Burger King, the largest Burger King franchisor. Portillo's hot dogs, Texas Roadhouse steaks. Sainsbury, big one in the UK that has spread out from there. Then, of course, once again, we get non-food being below food. Now, this is fascinating. I mean, why there's more growth in food on an earnings estimates basis versus non-food, we got to think hard about that. But it's fascinating to notice that food, in all three cases, is always completely on top of non-food. Just an interesting situation to think about. All right, top 8 to 9 stocks by market capitalization. Revenue here. This is the revenue chart. Earnings here. This is the earnings per share for the forward 12 months. And down here, free cash flow. So obviously this is, going to have revenue forward 12 months is going to be the biggest companies out there. And of course, to no surprise, Walmart is the biggest. Over here in the non-food space, of course, Amazon is in the business. So over here, you've got the food businesses. or the non-food businesses all over here, and with the food businesses. Walmart and Amazon. Of course, Walmart is the biggest. CVS is the next. Kroger. Down here, Yum Brand's the smallest. What you like to see is something like this, though. Be careful, because this is booking, and it has really been growing fast coming up. That's going to be important. And of course, you can see Amazon, but at the same time, it's starting to tail out from what it was pre-COVID. Down here, Chipotle Mexican Grill, from a earnings perspective, is remarkable. This stock is doing nothing but go up, and it's strong. McDonald's is right next to it, but lower. Booking of Cook, like I talked about, is from an earnings per share perspective, just, an incredible stock. Very different by business than the rest of these, so keep that in mind. Down here, free cash flow. Walmart sticks out quite noticeably, and they bounce back quite noticeably. So Walmart is a business that you got to think about. And of course, over here, to no surprise, perhaps it is a surprise, Alibaba. Cash flow has been phenomenal with this company. Stock's way down because of the geopolitics of isolating China. People not wanting to invest there, feeling it's uninvestable. But lately, people are buying Baba shares, and you can see why. Free cash flow is phenomenal. Baba. All right, so now let's get into depreciation, amortization, total debt, and reinvestment rate. Let's skip this one. I don't think there's much here for you. The total debt is interesting, and only in the case of CBS. You can see they did a big acquisition here and piled up a bunch of debt, $35 billion. They grew the company that way. Everything else is kind of normal. You wouldn't be too concerned about here. Down here is where there might be some interesting things. Chipotle Mexican Grill and Booking are showing this acceleration in their reinvestment rate, using cash internally more and more over time. So what has happened here? Of course, this is the interest rate effect. Debt, buying or using debt outside the company is more expensive now. So people are shifting to internal cash to stay away from those higher interest rates. So this is a fascinating story of growth companies that are now moving into using their own cash because of the rising interest rate environment that we're in. All right. Here we got earnings, return on equity, earnings pureness, and down here, the capital expenditure. So from a return on equity perspective, again, Chipotle Mexican Grill right at the top. Quick service restaurants. This is a mixture of Tim Hortons and Burger King. Down there is Kroger, and then you've got Compass Group, which is a UK-based food service company, kind of institutional-like Walmart, CVS, and TSCDY. Over here, TJX companies leading the way. Oh, but there's certainly strong names all over here and here to look at, and you want, of course, more return on equity than less. Down here, you've got earnings pureness. 95% for Chipotle Mexican, 100 from Home Depot. So again, you'd like to see businesses that are, basically pure fundamentals of the underlying companies. Down here, you've got capital expenditure. Walmart is leading the way. Amazon is leading the way. So this is the big stock story. If you need to build out these huge footprints, you need huge CapEx. And that is, to no surprise, singling out Walmart and Amazon as our stocks to look at. All right. Valuations. Higher valuation stocks are going to be the ones that are growth stocks, or people that are paying up for stocks. Enterprise value to free cash flow, somewhat similar, and we're going to find names in there that are worth knowing about. Free cash flow to net income. Again, we're going to find out who's at the top of this pile. So up here, Chipotle Mexican Grill, to no surprise, has the highest forward PE ratio, CVS the lowest. So you can almost think this is where you pay up for good stocks, and this is what's happening here, getting a ranking of the good stocks. Over here, of course, same thing, Costco and Amazon at top. Down here at the bottom, this is the value stock. Clearly, PE of 9 for Baba. Over here, you've got enterprise value, though, singling out Yum. And here again, Costco. Once again, Costco gets hit twice. Down here, free cash flow to net income, Baba, like we talked about earlier. Over here, you've got CVS. This is actually fascinating to think about. It's a really interesting chart. On we go. Top picks from the number of analysts covering the stock. Number of analysts covering the stock. All right. So first off, this is Chipotle Mexican Grill. Look how nice that is. This is classic. You just want to point out, though, at this point, it's fully valuing the growth in 2025. But this is, a really, really nice looking chart. Walmart, really nice recovery. They had some staggering around here back in 2022, but now they're right back on it. But again, fully valued. Over here, McDonald's, really nice chart. Not quite as nice as Chipotle, but still nice. And also fully valued. So down here, you've got Domino's Pizza, potential stock opportunity here. Quick service restaurants, that's the one with Tim Hortons and Burger King, basically fully valued, and DRI, Darden Restaurants. So get here, really nice chart, fully valued in all cases here, other than Domino's Pizza. But as you can see here, food and drug businesses have really done well post-COVID. And this is, people are getting out, they're shopping, they're going to stay home and they're shopping. Doesn't matter. Look at the food and drug businesses from a 3-month percent change in the forward estimate and its standard deviation. I just want to point out, Domino's Pizza standard deviation since COVID's been over has been pretty high. There's a lot of work, change in volatility at Domino's Pizza estimates. This is kind of why it's underperforming as a stock, is it's bouncy. Over here, who's bouncy? McDonald's is bouncy. So keep in mind, Domino's Pizza and McDonald's have some volatility with their standard deviations. A lot of movement in the underlying businesses. Yeah, this is not throwing these stocks away, but to be concerned about. All right, let's go on to the non-food businesses and their charts. So Amazon, of course, taken off. I just want to warn here, that is a consolidated business, and this is probably their cloud services. Amazon Web Services has taken them up. Stock is back at its highs, and it's basically recovered, in a nice pattern here. This is a COVID pattern. You see that a lot with Meta and Amazon. Target, kind of struggling as a stock. Again, fully valued at a lower set of estimates, but definitely concerning here. Booking Holdings, fully valuing the 2025 earnings. Really, the travel story, of course, has picked up. We all know the red veg travel story. Costco, really fully valued, but this is the stock you got to love a stock like this. As we talked about, we've seen that a number of charts getting highlighted, and of course, right here, you're seeing why. Really strong name. Lowe's, estimates have been getting cut, and the stock is actually, kind of holding up. Kind of a worrisome situation here for Lowe's. I wouldn't want to touch it. Over here is Wayfair. Wayfair has just been pounded, but people are actually thinking Wayfair is coming back here. Is there an opportunity in Wayfair? Good question. The chart says yes, but you've got these misses here, and you've got the stock not moving, so people are still not buying the story for Wayfair. All right, non-food, again, let's talk about the volatility here. Advanced auto parts is where the volatility is high. And then, of course, after COVID, during COVID, Ulta, because they shut their stores, basically, has had a lot of volatility. But here's the concerning one, advanced auto parts. A lot of bounciness on the stock. And again, if you look at the chart, getting pounded the last couple of years, people are really worried about advanced auto parts. It looks like a business issue, not a industry issue or a macro issue. And of course, up here, we've got Target, kind of bouncing around with its estimates. And of course, advanced auto parts twice flagged. Keep that in mind. All right, total return performances. Who should you have owned for the last 10 years or so? 10 years exactly. So Domino's Pizza would have given you 520% return over 10 years, 50% return. But, quick service restaurants gave you a 14% return. Really, these are the names you wanted to own over the last 10 years. Over here, of course, 800% return, Amazon and Costco at the top of the pack. Fascinating situation with Wayfair, like we talked about, the one that's really been pounded down. You didn't make much money 91% return over 10 years. So basically not too good. Walmart, from a market capitalization perspective, is just gigantic, and so is Amazon. So up here is where you got a total return story. You want to look at this. This is probably the most important part of these sets of charts. All right, PEG ratio. Of course, a lower PEG ratio might wear the growth, growth at a reasonable price, GARP, GARP. Who's here? In the food and drug business, is Starbucks is screaming it out, as well as Domino's Pizza. Who's not screaming it out is Walmart. That Walmart looks fully valued and then some. Down here, Amazon and Booking. Amazon actually gets flagged on the PEG ratio. Keep that in mind. Costco does not. You really have a 4.87, so just almost a 5p PEG ratio for cost. It's fully priced in, to say the least. Low and target might be where some valuation abilities here with some growth. Low and target might be an area to look at. These are the two areas. These are the 5 names that I would bother with here up in the food space and down here in the non-food space. Okay, now we're going to get in this last area, the Zacks Rank area, largest 1 month percentage change in fiscal year 1. Estimates. This is when they cranks up, people's businesses get picked up by our. So they're going to have a lot of number 1 and 2 rank stock in here. Keep in mind, net cash to market cap here, these 2 areas I starred are really where you're going to look to the top of these things. J. Sainsbury, a leading UK food retailer with some financial services. Here's the names. Big company. It gets flagged. And over here you get Fiverr, online marketplace based in New York. It also provides logo, poster, and brochure designing as Photoshop editing and a lot of different things. But basically, it's an online marketplace for selling. Dibs is the same kind of thing. All these names here, you got your Cava here, Potbelly, Texas Roadhouse, Shake Shack, and so on. There's Farmer. I would only be buying ones with net cash to market cap that's positive and stay out of this stuff. But again, here you get your Shake Shack that's somewhat negative, but it's doing great as a stock. So yeah, keep that in mind. It's just what I'm thinking as a top end screen. Over here, same issue. Probably want to stay with the positive ones. Price to sales, flagging the ones that people like. Again, probably the names people like, the ones they're paying up for. Amazon over here, Cava over here. Cava is that Mediterranean restaurant chain that IPO'd, in the last year or 2. And it's top of the list here again, twice over. Enterprise value to gross profit and price to sales. Cava, same story. DEC, no question, that's the same story here. So you're going to should be no surprise that this and this and this and this, these 2 rankings are going to be basically the same, which is why I think, keep this top one as your main target. All right, so here I'm only going to focus on free cash flow yield and earnings forward 12 months. These are the 2 areas I think you can focus on. The tax rate, of course, doesn't matter much. Again, you'd like to see a higher free cash flow yield. There's your names. And over here, same thing. Fiverr up at the top. Taste up at the top here. J. Sainsbury and earnings forward 12 months gets flagged again. And over here, Builder, ticker BLDR. That's the home improvement store that you probably don't know as much about as low as Home Depot, but it's really been a great stock since the COVID pandemic ended, holding up quite well. All right. Return on investing capital, trailing 12 months. Long-term debt to capital and CapEx to total assets. Let's not bother with these 2 charts or this idea. Down here is where you might have some ideas from a stock perspective, because return on invested capital is what we're looking for. So look through these names. DEC over here, Builder, of course, jumping out of Amazon, Fiverr, the same names that we've always been looking at. Over here, you've got a different set of foodie names that you can play. All right, that's it for me. John Blank, PhD, Chief Equity Strategist and Economist at Zacks Professional Services. You can get all these slides from us in 3 ways. 866-794-6065. Just give us a call. 866-794-6065. Reach us by email at strategycall@zackspro.com. or follow us on the web at www.zackspro.com. Those are the easiest ways. We also got a LinkedIn page at Zacks Professional Services, and we're on Twitter at ZA Tools. But, like I've shown you and like we do with all these talks, it's all about the data and the slides. It's what we do here as a company. We're an information provider trying to help you invest better and make better choices. Obviously, one of the top picks is the way to go. 866-794-6065. Strategy call at zackspro.com and www.zackspro.com. Thanks much, everybody. Until next time.